Good morning.
Morning. Very nice to be here. Thank you for the invitation. And a real pleasure to be here to have a conversation about the Microcap Trust. Are you going to put the slides on the?
Yep, here we go. Great. So I'll move the slides. But I think, as usual, the best thing is if you just sort of talk us through what the fund's trying to do first, please, and then we'll move to questions.
Okay. Well, I was just going to skim through. I know we've only got 15 minutes. I'm just going to sort of put a tiny bit of background on, which is that just to remind everyone, the UK stock market has underperformed for 30 years versus the mainstream market. In part, that's because they're very heavy capital-intensive businesses, not exclusively, but that includes, of course, mining and energy, which obviously is quite a bit high profile in the London market, but also quite a lot of other capital-intensive businesses are financials. They can obviously require a lot of capital. And the problem with a lot of capital-intensive businesses is as capital becomes cheaper and cheaper and cheaper, the ability of new competition to set up when you get a lucrative patch becomes easier and easier, and therefore it's been a long period where actually all those capital-intensive businesses haven't really risen a lot compared with a global stock market which has risen a lot. The net effect is that actually the UK market's underperformed. It produces lots of return, but it's underperformed. If you go back to say 2000, the market was something like 6.9. It's now about 7.4 in terms of the FTSE 100, and so it's hardly appreciated. It has produced a return going forward. If we move to the next slide. To the next slide. Yeah. During this period of underperformance, it's been undervalued and it's become progressively more undervalued. FOMO, the fear of missing out, which is often people talk about, in the case of the UK stock market, it's been fear of not getting out because people are making money elsewhere. So there's been a kind of race to get out of the UK stock market. Local investors have reduced their weightings. International investors have become completely disillusioned. And so we've seen the valuations move down to substantial discounts relative to the mainstream market. If we move to the next slide, James. And if anything, what's been interesting is that even as the UK stock market's recovered, and let's just remind ourselves, the good and growing income becomes more valuable when capital costs go up. Effectively, companies generating surplus cash start to have all the advantages. Companies generally, the whole effect of interest rate rises and inflation generally is that most people run out of money, most individuals, most corporates, most governments. And so it's been a period when companies generating surplus cash have started to outperform. We've seen that in the UK. The FTSE 100 is the best performing stock market pretty much around the world over the last 2.5 years. But even so, what we've seen locally is that people have said, oh, thank goodness for that. I can take some money out of the UK and I can put it into bonds, which now have a proper yield, or into cash, or perhaps buy back into some of the US assets, which have fallen back enormously. And so we've seen wall-to-wall selling really in the UK market. And that's been offset in the international markets by new investors coming into the UK stock market and saying, I wouldn't mind rebalancing from some high beta stocks, the volatile stocks, back to income generating stocks like in the UK. And so that's why the UK market's gone up. But in smaller companies, they've absolutely been shot to pieces. The AIM market's just hit a new low again. Having hit a low in October, it's hit an even lower low recently. So coming back to it, we're looking at a period where underperformance of the sector has led them to extraordinarily low values. You move on, James, to the next one. The biggest problem really is going forward. I think, there's huge recovery potential for the UK stock market. There's huge recovery potential for the smaller end of the UK market. But the biggest question mark, I think, lies in how us as fund managers manage this transition. What you see, this is looking at profit margins across the US economy back from 1957. And you can see profit margins are typically high in low inflationary periods when debt's cheap and stuff. But what you see is when you put up inflation, when inflation comes and interest rates go up, then you do find that profit margins go down. They can recover to some degree. But what we saw in the 70s was, yes, we saw a couple of false starts, but ultimately profit margins across the US economy halved. And so we are making the assumption that over the next 10 or so years, perhaps global stock market profit margins will halve again. And the question is, how do you pick stocks which are able to offset that and can generate good returns? And that's most particularly often not just companies who are investing, not companies which happen to be, got a new product, but most particularly companies which deliver not good but outstanding levels of service. We are tremendously interested in companies which aren't just delivering good service, but delivering outstanding levels of service. And we engage in companies, and that's one of our principal objectives for selecting stocks. Doesn't mean you're completely resistant to margin compression, but it means that when customers come to you and say, we're going to go somewhere else because there's someone else charging less for the same service or the same product, You can say, well, you could do that, but actually you won't get the levels of service. And so you do get an opportunity to not just survive, but actually continue to thrive. And that's particularly the case when interest rates go up and companies start to go bust. If you move to the next slide, please, James. So what we're worried about is that, you know, the mainstream stock market may lose a lot of its momentum, upward momentum. What we saw in Japan when it peaked out in 1989 was as margins came down, as valuations came down to previous norms, you saw the Japanese stock market come down pretty hard. And although it's recovered somewhat since then, it's not really hit the same levels as it was in December 1989. So effectively, we could have a long period where mainstream assets produce very little return. And if that is the case, then investors are going to become horribly interested in those areas which can buck the economic trend. And the great advantage of you know, an unsettled world, I think a global recession is very likely going forward, is that as companies go bust, quoted companies generating surplus cash don't just survive, but they actually thrive. If you move to the next slide, James. So the opportunity isn't just for us to invest in quoted companies, which are very lowly valued at the moment, but it's for those quoted companies to make further acquisitions of viable businesses which were over borrowed prior to the downturn. And many of those businesses are private. Some of them are involved as subsidiaries, and some of them are sort of zombie companies and all the rest of it. And the great advantage of these companies is that they can buy these assets as low as £1. Now, clearly, it's not just £1 because you have to put working capital back in again. But to talk about the upside, the opportunity for investing in the smallest quoted companies, which have the advantage when things are unsettled, and the upside of acquisitions is demonstrated by the recent acquisition of Made.com by Next. So Made.com, as you remember, came to the stock market 4 or 5 years ago. It was valued at 500 million. It touched 775 million actually in the pandemic, selling its sofas. It went bust last year. It was bought by Next, not for £1, but £3.4 million. They probably had to put 25 million of working capital in. We don't quite know what the number is, but say it's a 30 million acquisition, and say it's not worth 500 or even 700, but say worth 330 million to make my maths easy. So they've added 300 million of uplift for 30 million investment. That is good business, and we want to get our companies involved in those kinds of acquisitions. Next happens to be 8.5 billion market cap, and 300 million makes a difference to 8.5 billion market cap, but only about 3 or 4% difference. The real excitement comes to investing in small companies in this environment. Small companies, say a tenth of the size of Next, say 850 million market cap, then you know, for 30 million you can get a 300 million pound uplift. Well, of course, that's 30 or 40% uplift. And as you move into the microcaps, the companies below 150 million market cap, if you were an 85 million pound company, for example, you don't have 30 million. You have to come and see funds like ourselves and some of you. But by doing so, you can raise capital, probably raise a bit more just to be safe, maybe 40 or 50. So you might have a company valued at 150 million market cap after it's raised money, bringing in an acquisition which adds 200 million, sorry, 300 million to the uplift. So basically a 200% uplift in value. For the first time in 30 years, I think it's an advantage to be a listed company because you've got a stronger balance sheet, but you've got the opportunity to raise capital, and you can actually thrive at a time when companies going bust. That is the opportunity for the UK microcap sector. Obviously, people worry, if you move to the next slide, James, that actually the nightmare is that actually during periods of recession, the UK economy can actually not do very well. We've got worse inflation. If you go back to the 70s, we had lots of strike action. The IMF had to come and rescue the UK in 1976. You know, we had 3-day weeks. Surely, why would you buy domestic earners when currency is so weak? And coming back to this is looking at what happened last time. Small caps have outperformed in the last 30 years, but so what? Everything's outperformed the UK stock market in the last 30 years. But coming back to that time, that dark blue line, the UK stock market was one of the best performing stock markets in the world. And so we're looking at a period really where the UK outperforms because it's generating surplus cash when cash is short. But those smaller companies, you can see there, the 850 million pound companies, the light blue line, didn't just make 76 times your money, you made 400 times your money over this 3-year period. And if you look at the microcaps, the 85 million pound companies, the green line, 1,100 times your money. So the opportunity for getting into a green line, which outperforms not just international stock markets, but the UK stock market as well, is tremendously exciting as far as we're concerned. So if you move to the next slide, the nature of the strategy, therefore, is to have funds focused on microcaps. An investment trust is a particularly suitable structure for this. We think when there's if there's an investment desert coming in the future with indices producing very little return, then there's only going to be various niches and seams of return. We think that a unitized vehicle which perhaps was investing in microcaps might find that there's too much institutional capital coming in. It gets too large to invest in the microcap sector. Again, a quoted investment trust is the way to restrict the supply of investors into the fund. Ultimately, microcaps have a period of tend to outperform, but we select for companies which are finishing a period of investment and entering this cash surplus phase afterwards. We think that means that once they generate cash surplus, even if you have a recession or a change of government or whatever, you're in a strong position. It's quite a long list. People think perhaps we can't make our mind up. No, that's completely the other way. There are quite a lot of 25 and 15 million pound companies out there with outstanding prospects, where if you had a longer list, if you had a short list, say this fund gets to 300 million in due course, we think it will expand in due course. If it got to say 300 million, that's for the directors to determine in due course. But if it did get to that stage, if you only had 50 holdings, then of course you'd be basically putting in 6 million in each holding, and you wouldn't be able to invest in the 15 million pound companies or the 25 million pound companies with the upside. So to invest in smallness, you need a long list. We have a real preference for companies which are resilient through difficult times. Share prices might go down, but they don't need new capital. So strong balance sheets very much favoured. And then the opportunity for add value. There's very few professional investors at this end of the market. The opportunity for adding value to that green line I showed you earlier is tremendous. So we've got a real upside potential as a result of that. The nightmare is, of course, nobody's interested in UK small caps at the moment. The institutions have been selling the OICs. The share prices are going down. And we've been there before. If you go back to 2019 in the May government, if you remember at that stage, there was real worries that Parliament would not agree an exit with the EU, and we would go into WTO, World Trade Organization, trading arrangements with the EU. So microcaps underperformed, this fund underperformed, and then we had the pandemic, it came down even further. But what was interesting, after it bottomed in March 2020, was the value of the NAV rose not quite threefold, between 2 and 3-fold after that. So when it comes right, it can come very, very right. I think that's a glimpse of what could happen in the future. Obviously, if you go to the next slide, James, what you can see at the moment is, of course, no one's interested. We see in the mainstream stock market holding up pretty well. As I say, pretty much the best performing stock market in the world. I think that's a pattern which will continue. I think the UK will continue to be one of the top performing markets. Most investors are underweight. Most investors, the valuations are unusually low. You can only get 10 or 20 years of outperformance of an industry sector or market if most investors start off in an underweight position and if the valuation starts off an ultra low valuation. But then, of course, the really cheap part of the UK market is quoted companies, small quoted companies, microcap quoted companies. Valuations are incredibly low at the moment. So we're looking for that turn, a bit like we saw in March 2020 for this market, for the fund, not just to outperform, but outperform handsomely. So going forward, if you look at the current performance, of course, it's very weak. It's relatively weak relative to the under small cap funds. It's relatively weak relative to even some of the indices, which tend to be dominated by the bigger end of their makeup. But most particularly, the companies themselves, we're tremendously happy with, and we can talk about that in a minute. But most particularly, we think the upside potential, when it comes, could be very substantial. And as I mentioned earlier on page, if we go to the next slide, James, the nature of the upside is when it comes is because most people are underweight and because the UK outperforms and most people want to hold an outperforming market and maybe alternative markets aren't making any money, you get into a virtuous spiral. That is what we anticipate. We think this virtual spiral may last, say, 10 or 20 years. We don't know this, how long it'll be. It started, as I say, probably about 2.5 years ago. Nobody's talked about it as yet. Of course, they haven't really noticed. Local investors are still selling, but international investors are offsetting the local selling. That's why UK's already started to go up. If we see any diminution in UK selling, local OIC selling, then I think the UK stock market will break out on the upside a bit like Japan. But most particularly, I think the duration and the scale of that outperformance may surprise on the upside. If you go to the next slide, this is a sort of relative performance chart between the all-share index and the S&P 500 index. Going back from 1965, most of us in our investment careers know about the green line. Low beta stocks, income shares, stable companies producing an income generally have been overlooked relative to the much faster growth companies of unicorns and cash consumptive companies in the US particularly. And so we've seen the all share massively underperform versus the S&P index for the last 30 years since the late 80s. And what we've seen now, of course, is the start of the UK starting to outperform. With inflation, it changes everything. As you can see last time, we don't know if it's going to be quite the same this time, but last time the UK market didn't just keep up with the S&P, it massively outperformed. When everything's short of cash, the advantage of having cash surpluses is that you can not just survive, but thrive by buying acquisitions from the receiver. This is the mainstream stock market. Normally, when I've been seeing clients, I tend to talk about us outperforming the mainstream UK stock market, and that's fine, but everything outperforms the UK stock market in the last, say, 30 years. But going forward, if the UK stock market continues to be one of the best performers, and if this fund does have a catch-up period and starts to outperform versus the UK market, and I think it won't be just one catch-up period, I think hopefully there'll be a series of them in the future, then the UK market will be one of the best performing stock markets in the world. This will be one of the best performing parts of the UK stock market, hopefully one of the best performing added value through stock selection as well. So when you compare this perhaps with international strategies and other areas of investment, you find that this is a very rich seam of investment. We think that most of the competition will start to come down from the mid cap into the small cap, into the micro cap. I'm talking about some of the other small cap investors. And as that happens, you get new flows in, drip, 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 valuations are not falling, they start rising. And you get this period where these companies have increasing access to capital at a time when you can buy assets for distressed valuations. To conclude, the bottom line is, next slide, to conclude, the UK stock market is completely different from most other global stock markets. Cash compounding, capital intensive businesses have been popular during inflationary periods in the past. Quoted small caps, particularly quoted microcaps, have a history of outperforming the UK stock market. It has over the last 30 years, but so what, everything else has. But during inflationary periods, the advantages of being listed and the advantages of buying assets from the receiver enhance the opportunity to thrive rather than just survive. We believe that the fund itself, the trust, contrasts with others in a skew towards companies with strong balance sheets, but also companies generating cash surpluses. We're not trying to pick up the next Apple or whatever. We want companies, ordinary companies, generating plenty of cash surplus. To date, they've been very much depressed by local selling, UK OIC selling, very few buyers coming into the sector. So valuations of anything have gone, which were cheap before, even more attractive. And we're looking forward to a virtuous spiral, which we think has already started in the mainstream stocks, but we think that'll extend down to small companies, microcaps particularly. And when that happens, hopefully this fund will be a strong performer in future. With that, James, I'm very happy to answer any questions.